Starting with the new question, let us see. Perfect Incorporation, a United States-based pharmaceutical company, has received an offer from Aidscure Ltd, a company engaged in manufacturing of the drugs to cure dengue, to set up a manufacturing unit in Baddi, Himachal Pradesh, India in a joint venture. As per the joint venture agreement, Perfect Incorporation will receive 55% share of the revenue plus a royalty of $0.01 per bottle. The initial investment will be rupees 200 crore for for machinery and factory. Scrap value of the machinery and the factory is estimated at the end of the 5 years to be rupees 5 crore. The machinery is depreciable at the rate of 20% on the value net of the salvage value using the straight line method of depreciation. An initial working capital of 50 crore shall be required and thereafter 5 crore each year. As per Government of India direction, it is estimated that the price per bottle will be rupees 7.5 and the production will be of 24 crore bottles per year. The price in addition to inflation of the respective years shall be increased by rupee 1 each year. The production cost shall be 40% of the revenue. Income tax rate is only 30% and 35% tax rate in United States of America. That is DTAA, Double Taxation Avoidance Agreement between India and United States of America. According to the agreement, tax credit shall be given in the United States for the tax paid in India. In both the countries, taxes shall be paid in the following year in which the profit have arisen. So it shall be paid in the following year. Spot exchange rate is rupees 57. Inflation rate in India is 6%. It is expected to reduce by 0.5% every year, and in United States it will be only 5%. Straight 5%. As per policy of Government of India, only 50% of the share can be remitted in the year in which they are earned, and the remaining in the subsequent year. Though weighted average cost of capital of Perfect Incorporation is 13%, but due to risky nature of the project, it is expected that a return of 15%. It expects a return of 15%. So basically this 13% information is of no use. The required rate of return for the US company is 15%. Determine whether Perfect Incorporation should invest in the project or not. From the subsidiary point of view, you are required to take the decision. This is the way, so the question is providing the information. So friends, over here basically information is provided to us. Let's say there is a US company called Perfect Incorporation. It is going to take up a project in India, and for that, so the information is provided to us. Perfect Incorporation, a United States-based pharmaceutical company, has received an offer from Aidscure Ltd, a company engaged in manufacturing of drugs to cure dengue, to set up a manufacturing unit in Baddi, Himachal Pradesh in India joint venture. So you come over here and let us establish, say, a venture, say, in which we are going to manufacture a product which will cure dengue. So it is a pharmaceutical business. As per the joint venture agreement, Perfect Incorporation will receive 55% of the share of the revenue. So as far as the income is concerned, income is provided as 55% of share of revenue. Second, royalty of $0.01 per bottle. Investment, an investment of 200 crore for machinery and factory. So fixed asset investment, an amount of rupees 200 lakhs. Sorry, 20,000 lakhs. For machinery and factory, that is for the fixed asset. Scrap value of the machinery and the factory at the end of the 5 years is, so N is 5 years useful life, and income in terms of the scrap value, that is an amount of 5 crore, that is rupees 500 lakhs. The machinery is depreciated at the rate of 20% on the value net of the salvage value using SLM. So method of the depreciation is given. SLM, rate of the depreciation 20% after deducting the scrap value. Working capital of rupees 50 crore shall be required, and thereafter 5 crore each year. So working capital in the year 0 it is 50 crore, then first year another 5, second year another 5, and so on. So it will increase by an amount of 5 crore. So it is 5,000 lakhs initially and 500 lakhs later on. As per Government of India direction, it is estimated the price per bottle would be 7 rupee 50 paise. So the selling price of this pharmaceutical product will be governed by the Government of India, wherein the 7 rupee 50 paise is the selling price of year 1, that is price per bottle is provided to us per unit, and the production will be 24 crore bottles per year. So N is 2,400 lakhs per year. The price in addition to inflation of the respective year shall be increased by 1 rupee per year. So price is going to increase by rupee 1 plus it will increase at the inflation rate. Production cost information is given. It is 40% of the sales. Income tax 30% in India and 35% in United States of America. And whatever the tax that the US company will pay in India, so to that extent they will get the rebate, or to that extent say it is deemed that they have paid tax over there. So there is a DTAA between India and US. According to the agreement, tax credit shall be given in the United States for the tax paid in India. In both the countries, taxes shall be paid in the following year in which profit have arisen. So tax payment 1 year later. So whatever the income of year 1, on that you have to pay tax in the second year. Second to third, third to fourth, fourth to fifth, and so on. Okay. Next that they have provided is the spot exchange rate is 57 rupees per dollar. Inflation rate is given to us 6% in India. It will reduce to 5.5. Okay, it will go down. It will reduce to 5, it will reduce to 4.5, and so on. For the United States, it is going to remain 5%. Next restriction is provided to us. As per Government of India, 50% of the share can be remitted. So the remittance is allowed only 50% in the year in which the profits are earned, and the remaining in the following year. Cost of capital is 15%. 13% information is of no use to us. And you are required to decide that say what the company should do. That is, say the US company should do. That is the question. Everybody go through the question. I just give you some basic idea. From the US company point of view, we are required to say understand the entire question. The US company is required to step number 1, making investment of an amount of 20,000 lakhs. Okay. In step number 1 only investment, working capital, it is an amount of 5,000 lakhs. So that is a step number 1. Step number 2, simple depreciation. Use your calculator. 20,000 minus 500. Okay. So it is 19,500 divided by 5 instead of that into 20%. So 3,900 is depreciation, step number 2. Step number 3, that is terminal cash flow. In that, for the salvage value, there is a cash inflow of 500. And of course, we had computed depreciation by deducting the scrap value. So scrap value and WDV would be same. So there is no capital gain tax. Of course, there will be working capital recovery. For that, say we are required to see that what is the working capital recovery. Because apart from year 0, in the first year, in second year, in third year, even in the fourth year, we have made the, that is say we have made the investment of 500. So it is 500 into 4, that is 2,000 plus 5,000. That is the way we will have the recovery at the end of the 5th year. That is what we understand is a kind of working capital recovery. That is step number 3. Step number 4 is going to be really very important. That is recurring cash flow. From the US company point of view, the number of bottles into 0.01, that is the income which I am going to receive in dollar currency. Using the exchange rate information, we have to convert that into rupee currency. Plus, I will be having so the share of the revenue over here 55%. Considering that's the total income, we are required to make the payment of the income tax liability. And so on, further working is required to be made. Please go through the question so far. That is, I have discussed, and then we'll start with the answer. Should I write an answer? First point, from US company point of view, comma, we have to decide whether to make investment in India or not. Second point, we have to find cash flows in dollar currency for final discounting. Full stop. In bracket write down home currency approach. Bracket over. Step number 1, investment. In that write down fixed asset. It is 20,000 lakhs. Working capital, it is 5,000 lakhs. So it is 25,000 lakhs in year 0. Step number 2, depreciation. Cost minus scrap value into rate of depreciation. So 20,000 minus the scrap value is 500. That comes to 19,500. Into 20%, 3,900 lakhs. Friends, over here we are just making a small assumption as per the ICA suggested answer that this entire investment is required to be made by perfect incorporation for the portion of the profit that it is going to get. So basically over here we understand that this 20,000 lakhs is the investment to be made by perfect incorporation only. Apart from that, so there may be some other investment. However, we are not concerned with that. Step number 3, terminal cash flow. Year 5 end. In that, working note number 1, calculation of the capital gain or loss on sale of asset. So sale value of machinery is 500 lakhs less WDV. Friends, we understand that over here 20,000 minus 3,900 into 5. So 19,500 is deducted from 20,000. So return on value of the asset is 500 lakhs. So amount of the capital gain or loss would be 0. Working note number 2, calculation of terminal cash flow. In that scrap value of the machinery, it is 500 lakhs, that is this amount, plus working capital recovery. It is the initial investment that we have made 5,000 lakhs plus 500 lakhs year 1 to year 4. So the total it is 7,000 lakhs. So total it is 7,500 lakhs. Step number 4, recurring cash flow. In that, working note number 1, calculation of exchange rate for rupees per dollar year 1 to year 6. Friends, over here we are going to calculate the exchange rate for 6 years, because whatever the profit of the 5th year, For that, the income tax liability will be in the 6th year. That is the reason we'll compute the exchange rate for the 6 years. We'll use a simple formula. Forward exchange rate is spot into 1 plus inflation raised to n divided by again 1 plus inflation raised to n. That is the way we'll apply the formula. For the first year, 57 into, question is providing to us that the inflation rate for the first year is 6% and for United States it is 5% consistently, and from 6 it will reduce to 5.5. So friends, we have to be slightly careful. 57 into 1.06 divided by 1.05. It is 57.5428. I am taking up to 2 decimal. 57.54. For the second year, it is 57.54 into 1.055. That is the second year inflation rate for rupee currency divided by 1.05. That is for the United States. And importantly, for determining the second year forward exchange rate, we have to use the first year end forward exchange rate into account, because otherwise the equation would be 57 into 1.06 into 1.055 divided by 1.05 raised to 2. That is the way you can put the equation, and it will go on like this. So 57.54 into 1.055 divided by 1.05. So 57.81. Third year, 57.81 into 1.05 divided by 1.05. So of course it is going to be made same, 57.81, because the multiplication division is same, and so on. Fourth year, 57.81 into 1.045 divided by 1.05. So 57.53. into 1.04 divided by 1.05. $56.92. Sixth year, and further it has been given that say only 50% of the year's cash flow you are allowed to repatriate. $56.11. Friends, over here in the fifth year it is 56.98. into 1.035 divided by 1.05. So 56.17. This is the way we can compute the exchange rates. Now friends, after making this calculation, basically we understand that over here we are required to make the computation of the cash flows attributable to the US company. So for that, say what is the income, what are the expenses, all those things are required to be calculated. So for that, say we can have a kind of working like this. Working note number 2, calculation of income tax liability for the company. For income tax, say I am preparing a separate working note because I think that is an important working in this example. As far as the income tax calculation is concerned, we understand that say we will have the working like this. I am explaining that to you in detail for the first year. As per the given information, the selling price is 7 rupee 50 paise. The question is providing the information that the price per bottle will increase as per the inflation rate. The price in addition to the inflation of the respective year shall increase by rupee 1 for each year. What does it mean, friends? It means something like this. Listen carefully. As far as the selling price is concerned, first year it is 7.5, second year it will be 8.5 and so on. However, so the price will increase at the inflation rate. So we understand that so the selling price would be 7 rupee 50 paise into 1.06. Why? Because the first year inflation rate is 6% in India. In the second year it will be 8 rupee 50 paise into 1.055 and so on. So it will have the selling price for the respective year. We have been provided with the information that say the perfect incorporation will have 50%, 55% of the share of the revenue. Like that information is given. So whatever is the sales of that, the 55% belonging to me. Further, it has been given to us that so the 40% is the production cost. So whatever the production cost, after deducting it, 60% will belong to me. So what will happen? We understand that so the contribution, it will be like this: 7.5 into 1.06. It is 7 rupee 95 paise. And the second year it is 8.5 into 1.055. That is 8.9675. So I am taking 8 rupee 97 paise. The contribution will be like this: 24 crore is the number of units that we are going to sell. So it is 2,400 lakhs into 7 rupee 95 paise. This is the sales revenue that we have into 0.55. Why? Because my share is only 55% into 0.6. Why? Because I have to bear 40% of the production cost also. This is the way the contribution will be calculated for first year and so on for the remaining years. Then we will have the royalty income. As far as the royalty income is concerned, for that we understand it is 2,400 lakhs, that is the number of bottles, into 0.01, that is the amount in the dollar currency, multiplied with the exchange rate at the end of the first year, at the end of the second year, and so on. These two are income. From that, depreciation will be deducted to compute the profit before taxes, and then we'll make the calculation of the income tax liability. Friends, I am making the calculation of only and only income tax liability over here. The question is providing the information, whatever the income tax that say you have to pay, you don't have to pay in the same year. You will get the credit of 1 year. Means whatever the profit that you have earned in the first year, for that the tax is required to be paid in the second year. Second to third and third, then so on. That effect we will consider when we will prepare the cash flows. Because in cash flows, what will happen, dear students? We have to take care of one important aspect, that whatever the cash flow attributable to me, that entire cash flow I cannot repatriate to my own country. Half of that only the cash flow that I will be able to repatriate, and the remaining half will be repatriated in the subsequent year. So please write down this much working note, and then we are proceeding further. This is the second year, this is the third year, this is the fourth year, and this is the fifth year. Selling price is 9 rupee 50 paise, 10 rupee 50 paise, and 11 rupee 50 paise. Selling price would be 9 rupee 50 paise into 1.05, 9 rupee 975. Okay, so I'm taking 9.98. The next is 10.5 into 1.045. So it is 10.97 paise. Fifth year it is 11.5 into 1.04. That is 11 rupee 96 paise. That is the way we can compute the selling price. Contribution is importantly 2400 lakhs, that is the number of units, into the selling price. So this is the sales value into 55%, because my share is 55%. 40% is the production cost, so into 60%. And similarly for the other one, so 2400 lakhs into 0.55 into 0.6, that comes to 792 lakhs. That is going to remain same into 8 rupee 97 paise for the next year. So into 7.95 will give the answer for the first year, 6296.4. 792 into 8.97, 7104.24, and so on for the remaining years. Next, again it is 792 lakhs into 9 rupee 98 paise, 7904.16 lakhs. 792 lakhs into 10 rupee 97 paise, 8688.24 lakhs. 792 lakhs into 11 rupee 96 paise, 9472.32 lakhs. Royalty income 2400 lakhs into 0.01, so it is 24 lakhs dollar. So this 24 lakhs into exchange rate, first year, second year, and so on. That is what we have to mention. So here 24 lakhs into 57.54 for the first year, 1380.96 lakhs. 1387.44 lakhs. 1380.72 lakhs. 1367.52 lakhs. Depreciation we already have found it, friends. It is 3900. Based on that, so we'll get the PBT. So contribution is 6296.4 plus 1380.96 minus 3900. So 3777.36. And income tax rate in India is provided as 30%. So the income tax liability is at the rate of 30%. So 1113.21. This is what we understand. In the next year it will be 7104.24 minus 1387.44 minus, sorry, plus 7104.24 plus 1387.44 minus 3900. So it is 4591.68 into 0.30. So 1377.50. Next, third year, it is 7904.16 minus, sorry, plus 1387.44 minus 3900. So 5391.6 into 0.3. So it is 1617.48. Next, 8688.24 plus 1380.72 minus 3900. So it is 6168.96 into 0.3, 1850.69. Next, 9472.32 plus 1367.52 minus 3900, 6939.84 into 0.3. So 2081.95. That is the way we have the tax liability. Next, calculation of net cash flow in rupees and in dollar term. First of all in rupees term, and then it will be converted into dollar term. And importantly, this working note is required to be prepared for 6 years. I want you to tell me what is the net cash flow for the first year. Put your answer in the chat box. If you are not confident, you may do working in the rough and put your answer in the chat box. Let us see how to calculate the answer. As far as year 1 is concerned, what will happen? You will have the cash inflow in form of contribution, which we have calculated above. It is 6296.40. So it is 6296.40. Next, you will have the royalty income. Royalty income is 1380.96. Depreciation is a non-cash item, so we do not have to consider it. Then we have the income tax. However, whatever the tax that you have to pay in the first year will be paid in the second year. Okay, so as far as the first year is concerned, which I am talking about, in the first year, so the no tax liability to be considered right now. That is working capital requirement, an amount of 500 lakhs. That is the way we understand that the cash flow in rupees term, and then it can be converted into dollar term. So we have the cash flow like this: 6296.40 plus 1380.96 minus 500. So 7177.36. Till this point of time, everything is in rupees term. Now exchange rate that I will get from the first working note that we have prepared. 57 into 1.06 divided by 1.05. I think it is 57.54. Based on that, we can get the cash flow in dollar currency. So it is 7177.36 divided by 57.54. So that comes to 124.74. Now whatever the cash flow for the first year, that entire cash flow you cannot repatriate. Only half of that you can repatriate. So I'm writing repatriation. In that it is very simple. This amount 124.74 into 1 by 2. That is 62.37 in the first year and 62.37 in the second year. That is how we will have the repatriation of the cash flows. Now for the second year, the amount of the contribution is 7104.24. 7104.24. Royalty income is 1387.44. Now importantly, whatever the income tax that you had to pay in the first year, that will be paid in the second year. 1133.21. That is the tax liability. Again, working capital investment is 500. Use your calculator. 7104.24 plus 1387.44 minus 1133.21 minus 500. So 6858.47. Exchange rate for the second year is 57.81. So divided by 57.81, that comes to 118.64. So 118.64 divided by 2, that comes to 59.32. And so the remaining in the subsequent year, that is 59.32. That is what we will have. So now I'm preparing one more row, that is overall cash flow. As far as the first year is concerned, the overall cash flow is $62.37 in lakhs. Okay. In the second year, it is 59.32 plus 62.37. So it is 121.69. That is the overall cash flow for the second year. And so on, we will be having the working for the subsequent years. Next, third year, the amount of the contribution is 7904.16. Royalty income is 1387.44. Income tax liability is 1377.5. Working capital not subject to any tax adjustment, you have to keep it as it is. Exchange rate for the third year is, I suppose, same 57.81. And so on, we are required to write. Okay. Next, for the third year, it is 7904.16 plus 1387.44 minus 1377.5 minus 500, 7414.10 divided by 57.81. So 128.25 So 128.25 divided by 2, 64.12, and over here I am taking 64.13, so that the total is 128.25. Over here 118.64 into 1 by 2 and 128.25 into 1 by 2. So 64.12 plus 59.32 is 123.44. Okay. For the fourth year contribution is 8688.24. The royalty income is 1380.72. Amount of income tax liability is 1617.48. So 8688.24 plus 1380.72 minus 1617.48, that is 8451.48 minus 500, so 7951.48 divided by 57.53, so 138.21. 138.21 divided by 2, 69.10 and 69.11. So as far as fourth year cash flow is concerned, it is 69.10 plus 64.13, that comes to 133.23. That is the way, so we'll have the fourth year cash flow. Fifth year contribution is 9472.32. This is 1367.52. Fourth year tax liability is 1850.69 to be paid in the fifth year. Working capital is 500. $9472.32 plus 1367.52 minus 1850.69 minus 500. So 8489.15 divided by 56.98. So 148.98 divided by 2, 74.49. 74.49, it is 148.98 into 1 by 2. 74 point. Sorry friends, over here in the fifth year, I made a mistake. In the fifth year, we will write the terminal cash flow. The amount of the terminal cash flow is 7,500. Okay, that is the scrap value of the machinery and the working capital recovery. So last year there is cash inflow of 7,500. Accordingly, the net cash flow will be formed. Because those cash flows have been calculated in rupees term, so it is also required to be converted into dollar currency term. That is the reason. So next is 9472.32 plus 1367.52 minus 1850.69 plus 7500. So 16,489.25. 15 divided by 56.98, so it is 289.38. So 289.38 divided by 2, so 144.69. 144.69 plus 69.11, so 213.8. Whatever the income tax that you did not pay in the 5th year, that you have to pay in the 6th year. 2081.95. 2081.95. So 2081.95 divided by 56.17. There is a mistake on my end. फ्रेंड्स, ये जो कैश फ्लोस है ना, ये कैश फ्लोस को पहले स्प्लिट करेंगे, फिर एक्सचेंज रेट से डिवाइड करेंगे. आई एम सॉरी, कैश फ्लोस को पहले स्प्लिट करना पड़ेगा, because half of the cash flow you can take in the same year and half would be in the that is next year. तो what will happen, वो स्प्लिट करने के बाद जो कैश फ्लोस होगा ना, उसको एक्सचेंज रेट से डिवाइड करेंगे. Because in the subsequent year when you withdraw, at that time आपको ये डॉलर करेंसी नहीं मिलेगा, ये एक्सचेंज रेट के मुताबिक मिलेगा. Sorry, I made the conversion earlier. थोड़ा ये चेंज करना पड़ेगा. नेट कैश फ्लो सब बराबर है, ये वाला वर्किंग गलत हो गया. I'm sorry. हम लोग पहले वो नहीं कर सकते कन्वर्जन. जानवी आंसर सेम नहीं આવે. ફ્રેક્શન નો ફરક હોય ને એટલે આપણને ખ્યાલ ના આવે બેટા, પણ આન્સર સેમ નહીં આવે બેટા.